Yeah, day 17. We are starting with the problem sets for the second chapter. So, 1 second. Yeah. So, the first questions are from the Schweitzer Kaplan book, which is used for CFA as well, as I've recently come to know by a friend. So, yeah, the first question is, in what ways is preferred stock like long term debt? In what ways is it like equity? So the answer is, a preferred stock is like long-term debt because because like a bond, it promises to pay its holder a fixed amount of income each year. That is called a perpetuity. It also resembles a bond in that it does not convey voting power regarding the management of the firm. It is like equity because it represents ownership in a company, and the firm does not have the obligation to pay the dividends. Instead, the unpaid dividends just add up and get accumulated. Thus, it is more like equity since the firm is obligated to pay all its debts in case of bankruptcy. Second question is, why are money market securities sometimes referred to as cash equivalents? Money market securities are sometimes referred to as cash equivalents because they are highly marketable and consist of short term debt securities and are mostly in large denominations. They also have low credit risk and can easily be traded for cash, example T bills. Question number 3 is, which of the following correctly describes a repurchase agreement? Option A is the sale of a security with a commitment to repurchase the same security at a specified future date and designated price. The sale of a security, this is option B, the sale of a security with a commitment to repurchase the same security at a future date left unspecified at a designated price. Option C is purchase of a security with a commitment to purchase more of the same security at a specified future date. So option A is the correct answer. Question number 4 is, what would you expect to happen to the spread between yields on commercial paper and treasury bills if the economy were to enter a steep recession? So the spread between yields on commercial paper and treasury bills, steep recessions. So the yield would increase and become and widen because recession equals to high credit risk in commercial paper. So T bills appear as like a safe haven because they know that even in a recession, the government is insured and secured. So no matter what happens, the government will pay its debts. Like a government defaulting and becoming bankrupt is like an insane situation. So it's pretty unlikely. So therefore, T bills become like a safe haven, which means that lower interest rates due to recession. So like the banks want people to, not people but like whoever their debtors are, to want to have commercial paper, invest in commercial paper. So therefore they reduce the interest rates to attract them, therefore cause people to borrow more from T bills since government securities are cheaper. So okay, cause people to borrow more from T bills. Oh yeah, okay. So the T bill rate will reduce because of the recession, not the commercial paper rate. My bad. Maybe both reduce, but like it's saying the T bill rate reduces due to the recession. So therefore, people buy more T bills since government securities are cheaper. Thus, T bills more in demand. Price of T bills increases. Thus, investors who invest in it uh, earn less on the investments, and thus the yield decreases. On the other hand, the commercial paper yield increases since the price and demand for it goes down. Thus, investors get paid more on maturity. Okay, so basically the answer is basically saying that in a recession, the credit risk in commercial paper is high. So what does that mean? So the demand for commercial paper is now low. That means that not a lot of people are buying commercial paper, right? That would mean that whoever does buy commercial paper will get like a high yield return because there's not a lot of people buying. It's the same as if like if money demand is low, right? If money demand is low, that means interest rates will also become low to push up money demand back to equilibrium, right? Because if everybody wants to put their money in the bank is not going to give like a high interest rate to everybody. That doesn't make sense, right? So it'll start to give low interest rates so that people return to equilibrium. So that's how the seesaw of economics works essentially. So we get to see that in this question as well. So that mechanism is a very important part of economics. The demand supply thing and pretty much everything has like a seesaw function. And yeah, now let's move on to the fifth question. What are the key differences between common stock, preferred stock, and corporate bonds? So I made like a little table here. So there are a lot of features. Uh, First of all, ownership. So ownership, common stock, yes. Preferred stock, yes. Corporate bond, no. Voting rights, common stock, yes. Preferred stock, no. Corporate bond, no. Dividend slash interest, common stock, variable, not guaranteed. Preferred stock, fixed, paid before common stocks. Corporate bond, fixed interest, legally binding. Uh, Next is priority in bankruptcy. Common stock last. Preferred stock above common stock, below bonds, and corporate bond highest among the three. Risk, common stock high, preferred stock medium, corporate bond low. Return potential, common stock high, preferred stock medium, corporate bond low. Maturity, common stock no maturity date, preferred stock sometimes there's a maturity date, and corporate bond there's always a fixed maturity date. Traded on common stock stock exchange, preferred stock exchange, and corporate bond is traded in bond markets. So that was the fifth question. Now we move on to the sixth question. So sixth question is, why are high tax bracket investors more inclined to invest in municipal bonds than low bracket investors? The answer is high tax bracket investors prefer muni bonds because they are tax exempt compared to other investments. So therefore, if they're in high tax bracket, they would be able to save way more than people in low tax brackets. So therefore, often, high tax bracket investors prefer muni bonds because they're tax exempt compared to other investments, often exempt from state and local taxes. However, a low tax bracket investor, say 10%, doesn't really have an incentive to invest in muni bonds since the benefit in how much they save isn't as attractive per se, and therefore they prefer to invest in other high return investments. So basically, the amount of tax they are saving, like amount of tax that they are saving from paying, like you know what I mean, and compared to the return they are getting is just not enough. But for high net worth in investors and high tax bracket investors, the amount of taxes that they are saving from investing in muni bonds is worth it. So that is the answer to the sixth question. Seventh question is turn back to figure 2.3 and look at the treasury bond maturing in November 2041. So I've actually skipped this one on the doc since I didn't upload the table. So we have to do this on our own. So figure 2.3. I don't know if it means okay, figure, yeah, I got it. It's probably here somewhere. Yeah, this is it. So figure 2.3, look at the treasury bond maturing in November 2041. So November 2041 is this one right here. So the question is, part A is, how much would you have to pay to purchase one of these bonds? So 1 second. So the ask is 111.8203. What do we do with this information? Well, one second. Oh, we have to calculate days to maturity, I guess. But then, okay. Okay, so the asked price is 111.8203. So we do that, divide by 100 times like, was it 10,000 or was it 1,000? I don't know. I think it was 10,000. Oh wait, hold up. 1,000. Let's take 1,000. Let's take 1,000. Yeah. So we would have to pay $1,118.203 for for the bond. So that is the answer of part A. $1,118.203 for part A. Part B was what's its coupon rate? So coupon rate is given as 3.125. So I'll just take that as like 3%, 3.125%. Yeah. So that's just given in the table. We didn't have to do any calculations for that. And then part C is part C is also given. Our yield to maturity is also given 2.496. So yeah, okay. So question 7 is done. Let's move on. That took quite a bit of time, but yeah. Question number 8 is suppose investors can earn a return of 2% per 6 months on a treasury note with 6 months remaining until maturity. What price would you expect a 6-month maturity treasury bill to sell for? So face value, assume $100, default value, return rate is 2%, maturity 6 months, price equals to face value by 1 plus rate. So face value is 100 by 1.02, so that is $98.04 today. So that is the price you would be willing to pay for it today. Question number 9 is find the after-tax return to a corporation that buys a share of preferred stock at 40 rupees, sells it at year end at rupees 40, and receives a rupees 4 year-end dividend. Firm is in a 30% tax bracket. So tax on dividend 30% on rupees 4 equals to 1.2 rupees. Therefore income after tax equals to 2.8 rupees. Therefore 2.8 by 40 equals to 7% return after tax. So since there was no like capital appreciation, and the only appreciation was like the dividend, I guess, and then on the dividend you were charged 30%, so 1.2 rupees. So you only got 2.8. So 2.8 by 40 is like a 7% return after tax. So we found the return after tax, basically. After tax return, yeah. Question number 10 is turn to figure 2.8 and look at the listing for General Dynamics. I skipped this one again in the docs because again the table wasn't given. Like I didn't attach the table. So let me check the figure 2.8. It's given here. This one. So the question is, part A is how many shares could you buy for $5,000 for General Dynamics? So General Dynamics is this one, GD. So the price of General Dynamics at close was $142.97, I'm assuming. So you could have bought, 1 second, let me just put that in the calculator real quickly. 5,000 by 142.97. So you could have bought like 34 shares basically. Yeah, pretty much. So you could have bought 34 shares. Okay, that's part A. 34 shares. It's like at 0.9, so you can't buy 35 shares, but you can almost buy 35 shares. So if the price was like a little bit lower, then you could have bought 35 shares. But yeah. Part B is what would be your annual dividend income from those shares? So General Dynamics gives a dividend of $3.04 per share. So if you bought, but if you bought $5,000 worth of shares, so that would be about $15,200 in dividend. That doesn't sound right. Something sounds off, but maybe it's a dividend paying company, so I mean that sounds awesome. So 15,200 would be the amount of money a year end you would get from dividend. Part C is what must be General Dynamics earnings per share. So earnings per share. So there are how many shares? Yeah, 1375410 shares, and the earnings per share. I mean, we've been given the price per earnings. So if the price by earnings, if the P by E was equal to 15.39, then E is equal to P by 15.39, and we know the P to be equal to 142.97 by 15.39. So earnings is 9.289. I don't know. And okay. So 9.289 is the earnings per share for last year. Yeah, pretty much. Um, yeah, I might be wrong there, but like, yeah, sure. 9.289. Let's do that. Might be wrong though. We'll have to check that. What was the firm's closing price on the day before the listing? So yeah, 142.97. That's how we calculate everything pretty much. Answer 10 done. We have a few minutes left. Answer question 11 is calculate these. Consider the three stocks in the following table. P1 represents the price at time t. PT represents the price at time t. QT represents the shares outstanding at time t. Stock C splits 2 for 1 in the last period. Okay. So there are three periods, 0, 1 and 2. P represents the price, Q represents the quantity, basically. And you have three stocks, ABC. Calculate the rate of return on the price weighted index of the three stocks of the first period, T0 to T1. Price weighted index. Okay, so price weighted index. So if you took if you took these three stocks, it would be 240 by 3. So that's like 80, I think. And basically 240 by 3, and then we have 95 plus 45, 140, so 150, so that's 250 by 3. So 250 by 3, so that's like 3.3, so that's like 3.33333 divided by 80, so that's like a 4.16% return. Yeah, I might be wrong. Yeah, it's correct only. So I read it on my own. I'm happy. And part B is what must happen in the divisor for the price weighted index in year 2. So price weighted index in year 2, D equals to 195 by 83.33. 195 is the new sum of prices. 195 by because the quantity doubled, so we keep the same D like constant or whatever. So 83.33. Okay. So basically, to find the new D when the stock splits, we just divide the current sum of all share prices divided by the last price index. So price index at T1 was 83.33. So D equals to 195 by 83.33, which is equal to 2.34, which is a new divisor for period 2 since the stock C has split. Part C is calculate the rate of return for the second period T1 to T2. Rate of return 0% since the split doesn't affect the index value. So since the prices have been the same, as you can see, 95, 95, 45, 45, and 110 and 55, but then 55 has been 2, so it's like the same only. So it's 0% basically. And question number 12 is, using the data in the previous problem, calculate the first period rates of return on the following indexes of the 3 stocks. Part A is a market value weighted index, which is equal to price into shares outstanding. Let me just correct that. Market value weighted index equals to price into shares outstanding. So we'll compute the total market cap at T0 and T1. So at T equals to 0, A's market cap is equal to 9,090 into 100. B is similarly 10,000. C is similarly 20,000. So total market cap of all 3 stocks at T0 is 39,000. At T1, similarly, we find it's 40,500. Therefore, return rate equals to 1,500 by 39,000 times 100, 3.85%. So that was question 12. Oh, actually, I didn't solve that. I don't know how to do equally weighted index. You know what? We'll just skip that for now. 13th question. 13th question, given investor is in a 30% tax bracket, if a corporate bond offers 9% yields, what must municipals offer for the investor to prefer them to corporate bonds? So given tax bracket 30%, corporate bond yield 9%. Step 1, calculate the after tax yield of the corporate bond. After tax yield equals to corporate yield times 1 minus tax rate. So 9% times 0.7, so 6.3%. So for investors to prefer municipal bonds which are tax free, they must yield at least 6.3%. Finance municipal bonds must offer at least 6.3% or more. Given answer 14, find the equivalent taxable yield of a short-term uni bond currently offering yields of 4% for tax brackets of Part A 0. So what do we need to find? Equivalent taxable yield of a short-term uni bond currently offering yields of 4% for tax brackets of. So tax bracket 0, so equivalent taxable yield is 4% only. Tax bracket 10%, so 4% divided by 0.9, so that is equal to 4.44%. Tax bracket 20%, which is equal to equivalent taxable yield equal to 4% divided by 0.8, which is equal to 5%. Similarly for 30%, it's 5.71%. So we have all the equivalent taxable yields for all the 4 parts, A, B, C, D, 0, 10, 20, and 30. So as we can see, as the tax bracket is increasing, muni bonds become more attractive and more attractive because their rate after tax increases. Or should I say the amount of taxes that they save increase. So therefore the return increases in a way. Yeah, so 15th, question number 15th is, what problems would confront a mutual fund trying to create an index fund tied to an equally weighted index of a broad stock market? So mutual fund trying to create an index fund tied to an equally weighted index of a broad stock market would face the following problems. Number 1, frequent rebalancing. In an equally weighted index, each stock must maintain the same weight. As prices change, the fund has to constantly buy and sell shares to rebalance. This leads to high turnover. Point 2, high transaction costs. Frequent buying and selling means paying more in commissions, bid-ask spreads, and taxes, especially for smaller stocks. Part 3, liquidity issues. Broad stock markets include small cap and illiquid stocks. Buying large amounts of these stocks to match the equal weight can be difficult and might move the market price. Higher management complexity. Tracking a market cap weighted index is easier since it adjusts automatically with price changes, but with equal weighting, the fund must monitor and rebalance each holding manually and frequently. Tax efficiency rebalancing triggers capital gains, especially in taxable accounts, which can reduce investor returns. Performance drag because of the extra cost and small cap exposure. The fund might underperform a cap weighted version of the same index after fees and taxes. Question number 16 is which security should sell at a greater price? Part A, a 10-year treasury bond with a 4% coupon rate versus a 10-year T bond with a 5% coupon. So between 10-year treasury bonds, both have same maturity, but one pays 4%, the other pays 5%. Since 5% gives higher annual payments, should sell at a higher price. 10% bond with 10-year bond with 5% coupon should sell at a greater price. Pretty simple. The only difference was the coupon. So part B is a 3-month expiration call option with an exercise price of ₹40 versus a 3-month call on the same stock with an exercise price of ₹35. So call means that you want to buy. So obviously you would want to buy at a lower price. So the 35 would option deepen the money. So therefore call option strike price 35 should sell at a greater price. So its premium would be more expensive than the ₹41 basically. Part C is a put option on a stock selling at ₹50 or a put option on another stock selling at ₹60. So basically what we're saying is we can sell. So obviously the 61 will be more. So in this it's like opposite basically. Put option gives the right to sell the underlying stock. The higher price stock, the more downside potential there is. So the put becomes more valuable. Between a stock priced at ₹40 and another 60, the one at 60 gives more room to fall. Answer: the put option is stock selling 60 should sell at a greater price. So that was it. We are done for today. We covered 16 questions at a pretty amazing pace, to be honest. And yeah, I'm feeling good. 16 questions are done, and then we only have about 6 more questions, and then we have few CFA problems, and that's pretty much it. Yeah, we have done some e-investment exercises as well, and yeah, I remember these being like really exciting and fun. And then we will be done with the second chapter actually, and then we'll begin the third chapter probably day after we'll begin the third chapter, because tomorrow I'll do like a good video, good length, maybe 45-minute or maybe an hour length video, since I'm like really interested in this. So yeah, that was a good session. Thanks.